Hi everyone, this is Brandon Ketron and I'm here with John Beck. No, typically we would have Alan moderate these, but he is out of the office today, so I'm stepping in his place here to fill some shoes. So I'm here with John and we're going to be talking about passive rental losses and what that all involves. So just some upcoming advertisements here for other Learning at Lunch series that we have coming. We have Planning for Florida Dental Practices and Their Owners. That's part 2 of the presentation. That's going to be next Thursday with Alan. Success Tips for First-Year Lawyers and All Professionals. That's a 3-part series, and this will be the 3rd part. They're on February 20th. The Biggest Mistakes Physicians Make as Owners and Non-Owners in Medical Practice is coming up on February 27th. So feel free to sign up for all of those. These are all part of our free Learning at Lunch series. So today we're going to be talking a lot about real estate strategies under Section 469, which are the passive loss rules, and how those rules specifically apply to real estate and also non-real estate activities. So a couple of key points here that we're going to touch on. What exactly is a real estate professional and why is that relevant? John will walk through all the details of the requirements to be considered a real estate professional and potentially get out of the passive loss rules with respect to rental properties. Material participation is going to be a big topic of today's presentation. If you're a material participant, then you may not be subject to the passive loss rules, and we'll talk about the requirements for that. We'll talk about some strategies as to how to hold rental real estate, how to avoid some taxes associated with passive losses. We may get to vacation homes treatments and how that has changed since the passage of the Tax Cut and Jobs Act, and how 1031 exchanges, economic opportunity zones, self-employment taxes, and net investment taxes, how those all interrelate and how they are all relevant when you consider real estate and also the passive loss rules. So John, I'll turn it over to you to just give us a little general background here about Section 469 and what it does.
So generally we'll be dealing with 469 because this section acts to treat any business activity in which you don't materially participate as a passive activity. And the problem with that is passive losses will only be able to offset passive gains. So those taxpayers who have a bunch of passive losses and don't have passive gains to offset will be stuck with that loss, and they won't be able to use that to save on taxes in the future. And it's a little bit more complicated than many people think, and it's implicated in many parts of the tax code. So it definitely is important to have a good understanding of how to materially participate and to be aware of the different traps that may be present for your clients. So what is material participation? Material participation is the level of activity that is required before the IRS considers you to be active enough so the activity is not passive, so that you can offset regular ordinary income. And there are a number of different standards that can be met for a taxpayer to be active in a business, which we will discuss. But certain ways of qualifying will depend on a number of different factors that we're going to go over. So here we have the 7 different ways to materially participate. I'd like to point your attention to number 1, to number 3, and to number 4. So you can always qualify by participating 500 hours or more during a tax year. That's the golden standard. If you could meet that in an activity, you're going to qualify. There are some exceptions for real estate, which we'll go over, but in general, for most businesses, if you meet that 500-hour requirement, you will qualify. Number 3 is probably the second most common way to qualify, and there you'd have to spend at least 100 hours and participate more than any other individual. So that includes employees, that includes independent contractors. So whether you're going to meet this is going to depend a lot on other people's activities in the business. So that's just something to keep in mind. We'll go more in depth in the aggregation provision, which is number 4, and that's how you can aggregate activities in which you participate more than 100 hours each in order to meet the 500-hour test. And we'll briefly touch on the other ones later, but those aren't as important, especially for purposes of real estate.
I guess the key thing there when you are a material participant is that it allows you to not be subject to the passive loss limitations, meaning that if you have a loss in one of those businesses, that you can use it to offset any income, not necessarily just other passive income, which is the main purpose of these passive loss rules is to just limit your ability to deduct those losses. So if you have a rental activity, you can't just deduct it against your operating income. It has to be some other passive activity there. So if we can get around those and deduct it against other things, that's way more beneficial.
Right. So here, we're just going over the 500 and 100-hour test again, but I'd like to point your attention to the bottom of the slide, the active participation requirement. This is really primarily for real estate, and you can have a lower level of activity, basically just manage the company and be involved, and still deduct up to $25,000 against ordinary income, but there is a phase-out period between $100,000 and $150,000, so it's a 50 cent per dollar limitation after you reach $100,000 of income per year.
So if I am a low-income taxpayer, I have less than $150,000, I don't have to worry about any of the material participation test. I can deduct $25,000 no matter what.
You can deduct $25,000 as long as you actively participate, and we'll go over more of that later, but essentially active participation is just being involved with the management of the company, making decisions for the company. It's a much lower standard than meeting material participation standards. So if you're just an owner and you manage it and you only spend a couple hours a week, you could still qualify for that active participation benefit. And here's how the aggregation that I referenced earlier works. So here are just some hypotheticals. As I mentioned, you have to work at least 100 hours per year in each activity for it to count towards meeting your 500-hour test. So number one, you see they all exceed 100, and you're over 500, so you qualify. But if we go down to number 5, you'll see that we have a 500-hour test being met on activity 1, and then activity 2 is at 99 hours. Just because you met the material participation requirement does not mean every activity will qualify. Those activities in which you spend less than 100 hours are still going to be passive. So that's just something to remember going forward. So here are some types of income sources that are generally considered to be active sources of income. And although at first glance some of these might look passive, for example, the royalties, you'll see it's derived in the ordinary course of business. So there is some level of activity to these. And when we talk about the partnership as corporations, again, you have to materially participate. So this is the active deduction, so you don't need to materially participate. You'll see that there's a $25,000 exception, so you could deduct $25,000 of losses as long as you essentially participate at all in the entity. The one thing with the material participation test is that the spouse's time can be aggregated with the other spouse in order to meet the 500-hour test. But that doesn't mean that you're going to meet the real estate professional test, which we have a chart on later. Once you get into the real estate professional world and just real estate businesses in general, there's many more limitations, and it's much more difficult to qualify as being materially participating.
Yeah, so I guess when you look at this, you really have to look at it as two separate sections. One is non-real estate passive losses, where all you have to do is satisfy those material participation tests. And then you have the real estate passive losses, where you have to meet not only a material participant test, but also this real estate professional requirement.
Exactly.
So what are the requirements here for the real estate professional?
So to be a real estate professional, you have to spend more than 750 hours of your time each year working in real estate. And not only that, over 1/2 of your personal services performed during the year must be real estate related. This means that a person with a full-time job, even if they spend 750 hours during the year on a real estate related activity, will not qualify as a real estate professional. And to make matters worse, your spouse's time cannot be aggregated with your time for purposes of meeting the real estate professional requirement like you can do with the 500-hour test. But once one spouse qualifies, then both spouses can benefit from that one spouse's real estate professional designation.
Yeah, that's just a weird concept, is that you can't combine hours, but once one spouse meets the test, then the other spouse is also a real estate professional. Just, quirky rule there, it seems like.
Yeah, I think if you look at the 1/2 of personal services performed, it makes a little bit more sense, but it is still kind of strange, because how would you do 1/2 between both spouses? So I think they're really getting at, this has to be your full-time job.
Right.
But not really sure what Treasury was thinking when they passed it.
Who knows on a lot of things.
Right. So in order to qualify as actively participating under that $25,000 standard, we just have some more provisions here. You have to own at least 10% of the rental property. You have to make management decisions, as we mentioned earlier, and then you have the AGI limitation, and you can see how it's reduced on this slide. Here's the real estate professional chart. So just going through to show you how you can aggregate time to meet the real estate professional requirement. You don't need to spend 750 hours on just one activity. You can have multiple activities, but you do need to have the activity be over 100 hours. So for example, in C, you have 601 and 101 in the other two. That will qualify. But in D, where you have 749 hours in one and 99 in the other two, you're not going to qualify. Only that 749 hours will count towards meeting that test, and unfortunately, you'll be a couple hours short.
Harsh rule. But then it just goes to show that you need to make sure you follow the actual specifics of these requirements, because 1 hour short or even a minute short can make a huge difference.
Right, and I think it's important to remember that it's good to keep records. The regulations don't require contemporaneous records, but of course, having contemporaneous records will look a lot better if it's ever challenged, because you could show what you did each day. Otherwise, you're just going to have to argue that your activities would meet the 750-hour requirement.
Yeah, that was going to be my next question, so you hit the nail on the head. So I think, yeah, it's important. It's definitely a lot easier to track your time contemporaneously. As soon as you go out somewhere, just write down what you did that day and how many hours you spent. Or there's a lot of apps out there that are time trackers as well that you can use those. But again, make sure you retain those records, even though it may not be required. The last thing you would want is, in the event of an audit, not to be able to prove that you were a real estate professional or did meet a material participation test and not have any records to show for it.
Right, and if you don't have records, you're probably going to be subject to a negative inference. So the burden of proof is going to be on you to show that you actually did meet that standard. On slide 16, we just have a table that shows you the difference between having to qualify as a real estate professional and what you have to do to be active in a non-real estate activity. And you can see that on the left-hand side, this is where it gets really difficult to meet the real estate active business requirement. Again, spouse's time not counting, 750 hours and over 50% of your time. Not many people with a full-time job will be able to qualify as a real estate professional unless that job is in real estate. So short-term rentals, and we'll go over this more when we talk about vacation homes, but short-term rentals can be treated as active without the individual needing to qualify as a real estate professional. So as you can see here, there's 3 different categories. If the rental, average rental period is 7 days or less, then it's not considered a rental activity. And that would count for a lot of hotels and a number of other places where people just come and go really quickly. Then you have between 7 days and 30 days, but if the taxpayer provides substantial services, then it will not be considered a rental activity, and this would be similar to your extended stay type of hotel where they provide some sort of room service, maybe once or twice a week, and some other services. That would constitute substantial services under the regulations. But if your average rental period is more than 30 days, the activity is generally considered to be a passive activity. You'd have to meet the real estate professional and material participate in order to treat the business as active. So here are just a list of different types of real estate activities that can qualify, and you can see this is a pretty inclusive list. It goes all the way from rental services to developing the real estate. So most of the items will qualify, but it is important to actually look at case law if you have any question, because it's impossible for the statute and the regs to enumerate everything in this type of a situation. And we do have cases in this presentation, actually on this slide, that go into whether somebody's activities would qualify. On slide 19, there's some cases on what will qualify to be a real estate professional, and here you'll notice that this all has to do with the level of, well, how closely connected the activity is to the actual real estate. So in the first one, mortgage broker activities, those generally will not be considered to qualify, but if you look at the second one, Agrawal, you'll see that a real estate agent doesn't even need to be licensed to be considered a real estate professional. It's a little strange, but then in Calvinico, an appraiser was deemed to be a real estate professional because the appraisals are directly related to the real property. And then in the last one, you have a person who managed their own real estate endeavors and provided legal services to the company, and because that was connected to the real estate, that also qualified. Now, one of the issues when you do aggregate is that even though you can aggregate to meet the requirement, we'll go over this a little bit later, when you sell property, if you sell substantially all, then you could have an issue with the gain or loss being passed through immediately. And right here, this is the slide that shows that if you do sell substantially all, then when you sell, it applies to the aggregated group. So all of that loss or gain will pass directly through to the taxpayer. And when we talk about the 100-hour requirement, we refer to significant participation activities. So when we went through those charts and we looked at whether an activity had 500 hours, 100 hours, 200 hours, we had to meet at least that 100-hour requirement. The statute refers to this as a significant participation activity. So one of the strange parts about Section 469 is that managerial activities generally do not count towards meeting the material participation standard. So even though you may spend over 500 hours on a specific activity, if you're merely managing, those will not count towards meeting those hours, but it's going to be hard to differentiate between what are the managerial activities versus just regularly conducting a business. So we're not really sure how this would be applied, but we do know that when we look at investment activities generally don't qualify. An investment activity would be something like just analyzing financials to determine if you want to invest. So that's clear that that won't qualify, but separating managerial and active conduct of a business isn't that clear. So relatives and material participation on slide 24. As we mentioned before, you can count your spouse's activity in the passive business towards meeting the 500-hour requirement, but you can't count anyone else's time. And not only can you not count anyone else's time, it works against you. Unless you meet the 500-hour requirement, you have to spend more time working on that business than anyone else. That includes your children, it includes employees, independent contractors, everybody. And here's just a summary of the difference between an owner and an investor activity. So when you look up the regulations, you'll find that they refer to an owner as having a more hands-on approach to managing the company, whereas investors just analyze and determine whether they want to invest. And work performed by an owner is also a standard that must be looked at. For example, if you're trying to meet the 500-hour requirement, the work performed has to be work that an owner would regularly do. But if you'll remember, we did say that the spouse's time could count towards the 500-hour requirement. So if you hire your spouse to answer phones and it's a large hotel, that's probably not something that an owner would usually do. But if it's a small hotel, maybe 15 units or so, an owner might be there answering phones. So this is all facts and circumstances specific, and it's really important to look at the total activities of the entity at the business and the scope of what's being done. And another trap is that time spent before acquisition of the business does not count towards meeting your material participation requirement. So when you are looking at purchasing into a business, you might spend a significant amount of time to do due diligence, you might travel, all those hours just will not count towards meeting this requirement. But if you already have a business that's active and you're looking to expand it, it seems that you might be able to use those hours saying that it's conducting activities of your current business. And also, one thing that would come up quite often is you might have an employee who later becomes an owner or a part owner, and the time that that taxpayer spent working as an employee also will not count towards meeting the material participation standards. And here we have a summary of what we discussed earlier about active versus material participation. Generally, only individuals can actively participate, but there is an exception, and this is an important exception. If the taxpayer dies, then his estate can be deemed to be active for the 2 years after the decedent's death. So that just gives you more time to deduct passive losses against ordinary income through the estate. And the decedent's revocable trust can also qualify for that same type of treatment.
For the revocable trust, in order for it to qualify, do you have to make the 645 election to treat it as part of the estate, or can it just qualify on its own?
I'm not 100% sure on that, but I don't know.
Okay.
Dub that out.
Dub that one. So we'll back up. I think you have it in there, I believe. That's why I asked.
Oh, I might.
So if the trustee and executor choose to treat it as part of the estate.
Oh, yeah.
Yeah.
We'll just redo that one.
Yeah. Let's see. All right. So for the revocable trust, does the trust have to be treated as part of the estate using the 645 election, or can it just qualify on its own, regardless of whether it's treated as part of the estate?
It has to be treated as part of the estate, so you have to make the 645 election because this exception only applies to the estate.
Yeah, and the 645 election is something that can have some value as well. It can allow for additional deferral of income. So this is just another reason why you should consider making the 645 election as well. Now, when we talk about active versus material participation, so active participation really just relates to the rental real estate and whether you qualify as both a real estate professional and a material participant. Whereas material participation is separate, not really involving real estate, and just other non-real estate activities, right?
Yep, that's correct. And rental real estate activities that are held in limited partnerships are subject to special rules. So if you hold real estate in a limited partnership, you have to spend more than 500 hours on the activity in a given year, or materially participate for 5 of the last 10 years. So it's much more difficult to qualify if you're holding your real estate activities and businesses through a limited partnership. And also, if you contribute your real estate activities into a partnership, you generally are treated as if all of your real estate activities are held in a limited partnership. So for those taxpayers who are barely meeting their activity requirements or are relying on that 100-hour requirement for a couple different activities, it might not be a good idea to put those properties into a limited partnership. But there is an exception. If less than 10% of the total income from all real estate related activities is held in a limited partnership, then you don't treat any of the properties as being held in a limited partnership. Another exception is that if the taxpayer is a general partner as well as a limited partner, then the taxpayer will be treated as a general partner for all of its real estate interests, regardless of a percentage being held as a limited partner.
Okay, so now I'm going to skip forward to slide 34 and talk just a little bit about what types of entities is better served to hold real estate, since we're discussing real estate. For the most part, we prefer to have real estate held through partnership entities rather than S corporations. And some of the reasons why is you receive basis for debt incurred by the partnership without having to guarantee that by the shareholder. You can have the benefit of a 754 election. So when a partner dies or when a new partner buys into the corporation, you can receive what is the equivalent to a step up in basis on the inside assets of the partnership. Whereas if you have that real estate held in an S corporation, only the stock of the S corporation is going to get a step up and the underlying assets do not. So there's still built-in gain that would have to be paid. Whereas in a partnership, everything equals out to the current fair market value. You have no built-in gain, at least the portion of the partnership held by the partner that passed away. Same thing when a new partner buys in. If you have the 754 election in place, that partner is going to get their interest with the 754 election as if they're buying in at the fair market value that they've just paid for. Whereas in the S corporation, a shareholder that buys in, there's no similar adjustment for the underlying assets. Under a partnership, if you want to distribute out the property from the partnership, that can be done tax-free to the partners. If you have an S corporation, that distribution is going to have gain recognition at the corporate level before the distribution applies. There's no restrictions as to who can own partnership interests. You can have it owned by trust. You can have it owned by non-resident aliens. S corporations, as everyone knows, there's certain restrictions on ownership. You have to have less than 100 shareholders. They can only be individuals or trusts that make certain elections. You can't have that owned by non-resident aliens, a corporation, or another partnership. There was a nice provision added as part of the Tax Cuts and Jobs Act that allows an SBIT that has a non-resident alien beneficiary to be a permissible shareholder of an S corporation, but that non-resident alien can't own it individually. Partnerships, you can have more than one class of a stock. You can do preferred partnership payments. That could be very important if, depending on who invests into the real estate activity. They might want to have a preferred rate of return. You might want to allocate certain percentages to a preferred partner. You can't do that under an S corporation because you only have to have one class of stock. Everything has to be pro-rata ownership, including the income allocation and distribution rights. Now, the one exception here to when the S corporation might be more beneficial than a partnership is if you have a situation where the property has lost a lot of value, you might be upside down in a mortgage. If you file for bankruptcy and then you have cancellation of indebtedness income, the income insolvency exclusion under Section 108 is determined at the corporate level under an S corporation. So if you only have one asset that's upside down, you're obviously insolvent. You won't have income from cancellation of indebtedness. Under a partnership, it's determined at each partner's level. So even though the partnership itself is upside down, the partner could have cancellation of indebtedness income if the mortgage is canceled and they repossess the property, because the partner itself wouldn't be insolvent. So that's one situation where the S corporation might be more beneficial, but I think all these other advantages, far outweigh that situation, and have to have a pretty specific fact scenario where you're worried about a high-risk property to consider the S corporation. We have a couple of other slides here on the net investment income tax and self-employment tax planning. We're not going to go through these in detail. There's another webinar as part of the Lunch and Learn series that you can access on YouTube, where John and I believe Alan is also presenting with us on this. So we go through these slides in detail and talk about how you can really thread the needle, meaning not be subject to either the net investment income tax or the self-employment tax, because as most people know, they kind of operate in parallel with one. So if you're not subject to one, you're likely subject to the other. But there are situations where you can squeeze in between the two. Just to show you a couple examples of that, and particularly for real estate, one situation where you can thread the needle is have one spouse be the active owner and the real estate professional, where if you had that work, you would typically have it 50-50 between the spouses. One's the real estate professional, is an active owner, the other spouse is. Spouse one, who's the active owner, is going to be subject to self-employment taxes. Now, neither spouse one or spouse two are subject to the net investment income tax, because the active spouse is attributed over to the non-active spouse, and so you're not subject to the net tax. Now, what if you had the real estate entity owned 99% by the non-active spouse, maybe 1% by the active spouse, who's the real estate professional? Then the income attributable to the spouse who is not active is not subject to self-employment tax, because spouse one's activity isn't attributed over to spouse two. So spouse two isn't considered to be an active owner, not subject to self-employment tax. But for purposes of the NIT tax, spouse one and spouse two's hours are aggregated together, and you would get outside of the NIT tax. So that's a nice way to thread the needle in between the self-employment tax and the NIT tax. Another way that you can do this is if you have multiple entities and you spend more than 100 hours on each of these entities and can make that aggregation election that John spoke about. And you have to be a real estate professional if this is a real estate activity, so that 750-hour test must be met. But for purposes of the self-employment tax, for purposes of the NIT tax, you can aggregate all these together, exceed the 500 hours, not be considered a passive activity. You're an active activity, so you're not subject to the net investment income tax. Now, for the self-employment tax, you look at each individual entity together. So if you spend less than 500 hours on every one of these activities, but more than 100 that you can combine together to be over 500, then as long as you don't have over 500 in any one, you're not going to be subject to self-employment taxes. So that's another example of how you can thread the needle. Now, I know these in practice might be a little difficult to get yourself into, but when you see these situations, you can advise your client, well, hey, make sure we don't do anything to mess this up. This is a good scenario. So here we just have more slides on the net investment income tax that you can read through. We have some slides here on vacation homes and how those are treated.
And I'd like to,
after the Tax Cuts and Jobs Act. So John, if you want to give a little detail here, is this a good slide to start with here on the vacation homes?
Yeah, I think this is a good slide. This chart is a good little summary of the considerations that should be taken into account before determining whether to actually treat your vacation home as a rental, or if you just want to continue to use it as a personal residence. And one of the reasons why people would use the vacation home as a rental is to start deducting some of the property taxes and depreciation deductions that can be taken. And actually that's because of the Tax Cut and Jobs Act that limited the deduction of state and local taxes for property tax. So here you have to take into account what's going to happen to your mortgage interest deductions, the gain on selling your home or selling your home for a loss. That's all included on this chart. On two slides here. Then I'd like to fast forward a little bit to short-term rentals and the average rental period. So when you have a short-term rental, the activity can be deemed to be active, and this is more of an issue today with a lot of people renting out rooms in their homes through Airbnb and other private rental services. So while this might this might generate some extra income for those people, it could end up costing more than they think in taxes. So if the business is profitable, you might want it to actually qualify as a passive activity, whereas short-term rental is generally considered to be an active trade or business. The reason why is because when you're active, a lot of times you're subject to self-employment taxes, and then you also have other types of expenses and risks involved with short-term rentals. So it's always good to look at the self-employment tax implications before entering into such an activity.
Yeah, so I think we have some other slides here on the cancellation of indebtedness that I spoke about. Some comparisons between Section 469 and Section 199A as far as what counts for 500 hours under 469, and then what counts for that 250 hours safe harbor under Section 199A, where you're automatically deemed to be a trade or business that can qualify for the Section 199A deduction as it relates to real estate. There's some slight differences between the two activities and what counts and what doesn't, and we just listed those out here. Don't forget to join us for Florida Dental Practices and Their Owners, Part 2 with Alan coming up. The tips for first-year lawyers, that's the third part of the series there. And again, on February 27th, we have the biggest mistakes physicians make as owners and non-owners in medical practices. And we have our email addresses listed here. If you guys have any questions, feel free to reach out to us. We'll be glad to answer any questions that you might have, provide you with copies of any slides that you might not have access to, or any of the sheets here. We can send you the source documents as well. So thanks for joining us, and we hope you guys have a great rest of your day.